Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, August 3rd, 2020, and I am pre-recording this Trading Places Live for Tuesday, August 4th. Futures currently are down slightly. Last time I looked, I think the Dow Jones had about, it might have been down 10 points in terms of its futures. NASDAQ about the same, 10, 11 points. So not much, but there were a number of earnings reports out. There'll be a lot of second-tier companies reporting this week. So we still go right in the middle of earnings season. So far, it's been a great season in terms of beats. But as I go through today in this show, there were a number of companies that actually reported better than expected earnings that were down after hours. And so just because you're coming in with better than expected earnings doesn't necessarily mean that you will have a great market reaction. Many times stocks have already built in better than expected earnings. So that's something to keep in mind. All right, tonight I'm going to get into a few things with you. We'll start off with that daily market recap, then jump into talking technically. I want to show you a couple charts where when you look at the charts on a daily basis, you might think, hey, it's breaking down. And it may very well be breaking down, but when you move to a weekly chart, it doesn't look nearly as bad. And so I think it's always a good idea maybe to step back and look at that big picture before you make a decision on kind of the intermediate term picture. So I'll give you a couple examples of that in talking technically. We'll get into turning point. I want to show you maybe 3 or 4 stocks there that I think could be making a pretty significant turn. We'll get into earnings spotlight, where I'll go through a number of the earnings that are out after the bell today. And then 3 you must see. We'll wrap it up with a few stocks. Interesting one in particular has been beaten down pretty badly, but it looked like maybe we were putting a bottom in. So we'll take a look at that along with two others as we wrap up the show with the 3 you must see. All right, first, before we get into any of that, I do want to just point you to Earnings Beats Digest here at earningsbeats.com. This is our free newsletter. You can come in here, click on the name, email address, just complete that, hit the subscribe button, no credit card required, completely free. You'll get a very good indication and hopefully some education as far as how we look at the market. I think you'll be able to take some of what we do, combine it with what you probably already do, and hopefully improve your trading results. Also, if you notice, you'll see our portfolios. August 19th is when we redo our portfolios. So there will be a stock selection, a top 10 stock selection webinar coming up on the 19th. We actually have a sneak preview. The 19th webinar is for members only, but we do have a sneak preview coming up on Monday, August 10th. And everybody's invited, but we do require that you at least be part of our free Earnings Beats Digest newsletter. So we want you to be part of our Earnings Beats community, and we would love to have you in for that sneak preview. In that, I'm going to go through how I pick these stocks for the different portfolios. We'll take a look at some of the performance. We'll look at some of the stocks within the portfolios, and maybe even take a glimpse at a couple of stocks that might find their way onto the upcoming portfolios. So it'll be a real educational event. Again, that'll be on Monday, August 10th. But you do want to sign up for the Earnings Beats Digest because we will be sending out information to the folks in our community about that event. All right, let's move on. Taking a look at the action and the daily market recap from Monday. We've got the Dow Jones Industrial Average up 236 points, the S&P up 23.5, NASDAQ 157 points. Excellent relative strength once again from the NASDAQ stocks. And if you check this out, it was a new all-time high on the NASDAQ, so that's good. The S&P 500 also, by the way, close to 3,300. We're now within 200 points, or excuse me, we're within 100 points of that all-time high on the S&P 500 now. So only about 3% away, not far to go. Mid caps up a little over 1%, small caps up 1.25%. All the major indices continue to be in a nice uptrend. I think remain very bullish. From a sector perspective on Monday, technology led. That shouldn't be too surprising. That's what we've been seeing throughout most of the past several months and really last few years. Technology up almost 2.5% on Monday and breaking out to a new high, easily clearing that 110 level. Healthcare returning back to the leaderboard, the top of the leaderboard. You can see recently we've been doing some sideways consolidating, but we did recently make that breakout over 104, and we've been holding that along with the 20-day moving average. So that 104 area is now support. We bounced off of that, nice 1% gain on Monday. So healthcare also did well. Industrials up about 0.4% in the third spot. And then two groups, defensive groups, that did not do well on Monday. Real estate down 1.6% and utilities down a little over 1%. These two groups have yet to make the break above that June high, so they do continue to lag on a relative basis. Looking at the 10-year Treasury yield on Tuesday, looking ahead, we only have one economic report coming up, and that will be June factory orders, expected to rise 5.2%. May had risen 8%. So maybe the growth in factory orders slowing a little bit, but this is one of those reports that's still in our rearview mirror. I mean, we're in August now, and we're talking about June factory orders. Market's much more concerned about what's coming than what happened 2 months ago. So I don't think that the report, honestly, is going to have that big of an impact. But this chart right here, this 10-year Treasury yield, when you consider that money is pouring into treasuries, that's how the yield continues to go down. I mean, we're now down from 0.96% back June 5th. 2 months later, and here we are at 0.56%. So we have dropped 40 basis points in 2 months, while the S&P 500 has gone higher. Got to think about that for a minute, because when the yield's going down like this, it means money is rotating into treasuries. That's money that's not available to go into stocks. Imagine if bond traders decide that we want to bail out of bonds and start chasing the stock market. Imagine where the stock market could go, because I think this is what's going to fuel the stock market. You don't need the 10-year Treasury yield to go to 10%. You don't want the 10-year Treasury yield to go to 10%. But if it were to go from 0.56% to 1.5%, 2%, that would coincide probably with a massive rally in the equity market. So don't, take this too lightly. The fact that the bond market, you're still seeing a lot of folks going into the bond market, which indicates caution, which normally means the stock market would go down, but the stock market's been going up. And so that, to me, is absolutely a no doubt secular bull market reaction. There's no doubt in my mind this is a secular bull market. And I know I probably sounded like I was crazy 4 or 5 months ago when I was saying it, but hopefully you can see now what is going on. Even with money rotating and being defensive, we still have the stock market, the NASDAQ, breaking out to all-time highs. Very, very bullish action, in my opinion. All right, let's move on to talking technically. I wanted to go over a couple of one stock and one ETF. And when you look at these charts, I mean, when I look at Snap, I know that there are a lot of technicians that use moving averages, and that's kind of their go-to. It's something I follow, but it's not my go-to. And so I can understand why someone might look at this chart and say, wow, volume increased, heavy volume, and we broke below the 50-day moving average. That is bearish. I understand that argument, but I'm here to say I don't believe it's bearish. I think that there's going to be continued accumulation of shares of Snap. And if you look at this, the stock was at 26 and change back earlier in July, maybe around the 7th, 8th. And as it was pulling back, we actually saw another move higher in accumulation distribution. And even with this sell-off, we've seen very little deterioration in the accumulation distribution. Even today's action, which was down 5%, we closed 60 cents off the low of the day. This did not take much of a toll on the accumulation distribution. Why? Because accumulation distribution takes a look at where you finish relative to where you traded during the day. So if we shorten this, let's just take a look at, say, a 3-month chart so that you can get a really good look at this candle. So the high today, 21.89, the low 20.61. That is a range of $1.28. So halfway point would be 64 cents. So if you go to a low of 20.61 and you rally 64 cents, that would put you back at 21.25. So at 21.25, accumulation distribution would not change on Snap. Well, we finished at 21.22, so it went down just a tad. But overall, the action has been pretty good here. Now, the previous 2 days, you could see that we closed toward the bottom of those candles. And as a result, we saw the accumulation distribution line going down. But there have been plenty of days where, I mean, look at this day. This was a very heavy volume day. This actually saw the accumulation distribution go higher. Why? Because we closed in the upper half of that candlestick. Long tail to the downside. You see this over here at the 20-day? Looked like we were breaking down. We reversed on pretty good volume. AD line went higher. So we actually broke to a new AD high this day, even though we had gone down for the 4th day in a row. So don't just look at the moving average. There's more to a chart than the moving average. I use the moving averages, but I use them as secondary indicators, not primary indicators. All right. Now let's take a look at the weekly chart, because I would agree, hey, the PPO's gone a little bit negative. We're below the 50-day moving average. I would rather that we be above the PPO center line and above the 50. There's no doubt about it. But this alone is not going to be the thing that's going to chase me out of a stock. So let's go in and take a look at this weekly chart on Snap. Now take a look. We got the PPO, which was rising at the most recent high. We're pulling back, but we haven't even hit the 20-period test. We haven't even gotten a 20-week test yet. So today's low of 2061 was still about 50 cents above the 20-week moving average. From a long-term perspective, a 20-week test is the time to get in. Look at what happened back in May of 2019. Do you see this pullback? I'll bet you on the daily chart. Let's go ahead and pull this up on a daily chart back in early May, and let's see what happened to Snap. I bet you it had broken down. Let's go 2 years. All right, so if we go back to May, right here, see the breakdown? We're below the 50. Look at the PPO going below the center line. Look at the price action below the 50. If that's your go-to and that's your decision maker, you get out, right? You broke down below the 50, I'm getting out. Well, from a price perspective, we went back, we filled a gap, which isn't a bad thing. And as I just showed you on the weekly chart, we were hitting the rising 20-week moving average. That, from my perspective, that's the time to be getting in, not the time to be getting out. So don't always look at a break below moving average necessarily as a bad thing. Now, if we'd been consolidating for a while and we had already tested that rising 20-week moving average, and then we broke down and the volume was heavy and the PPO lost centerline support, it's a different animal. But I think we're still fine. From my perspective, I think we broke out. Probably this 2021 area is pretty solid. And as I mentioned, that's exactly the 20, little over 20 is where that 20-week EMA is. So I think Snap's got a little bit more downside, but I wouldn't be surprised to see a big reversal and another run back up toward this 26 level. The other one I wanted to show you is similar. I had a question from a member that, or actually I had a question from my Trading Places earlier today on Monday. Monday and Wednesday I always do Trading Places live over at Earnings Beats. And there was a question that came in, but I don't usually go through questions during the show. But I saw it and I thought, well, this would be a good question to talk about. Because the question was, do I still like IBB? I'm a big fan of IBB. I actually own IBB in one of my retirement accounts. So I think that biotech's going to go higher. But this was another example where at the end of last week, we came down. We were below the 50-day moving average. Volume picked up. We're sitting at this right about the center line. Is that bearish? You know, the question was, do I still like biotechs? Yes, I love the biotechs. Biotechs remain one of the strongest areas. And look, I mean, the accumulation distribution is still fine. But let's again go to a longer term chart. Let's pull up that weekly chart. Here's the biotech weekly chart. At the most recent high, the PPO is at a high. So when I see that, I look for the rising 20-week moving average to be support. Right now, that's down at 131. Today was a nice day. We're up 4, back to 138. But even at the low, or even at the low that we saw last week, we got down to about 132, 133. We're above the 20-week moving average. So big picture, in my view, still very bullish for biotechs. So I have no problems whatsoever. But I just want you to at least consider if you have a very narrow focus and you're only looking at the short term, I think you get whipsawed sometimes unnecessarily. And I think if you step back, take a look at the big picture, get a broader perspective of the market and your particular stock and your industry group, I think sometimes it would save you from getting unnecessarily stopped out with a loss. All right, let's move on to Turning Point. So on Turning Point, first thing I wanted to do was actually, let me pull up HIBB. I'll go with a relative chart. But now this is a heavily shorted stock. This is on our short squeeze chart list. And the stock came out with this big move up, heavy volume back on July 21st. Got up to over $28. We had gapped up from 22 and change, went above 28. We worked our way all the way back down, and it's been about 2 weeks. Today's low, 22.06. We filled the gap, and it looks to me like we printed a nice hammer. I think today's low is important because we are right down there near that 50-day. Maybe you go a little bit lower. In this case, I would say a move and a close below the 50-day moving average would bother me. And that's without even looking at a weekly chart. Why? Because this is a heavily shorted stock. A lot of people are betting against this stock, and they don't always get it right. But if I'm in a stock on the long side that is heavily shorted and it begins to show breakdown, there is no chance I'm going to hold. I do not want to hold a stock that's being heavily shorted. They may be shorting for very good reason. So I think this gap support, 50-day moving average, this whole area of support is really important. I would look for this to be a major turning point on HIBB back to the upside. And if it's not, and we come back down and we take out the recent low, I would be very skeptical and probably take my loss and move on. Next up for Turning Point is Shoe Carnival. This is SCVL. Hammer printed today, and it printed right at this gap support level. It's another one that's below the 50-day moving average and heavy volume. But there's your gap. See this gap right here? We gapped up, came down. We've tested this area once. And today we actually put in, it looked like a major breakdown. You look at the volume picking up on the stock. There aren't too many people that would have been buying the stock intraday. I certainly would not have. It's breaking down. There's no support. Why would we buy here? So who's buying? How did we reverse there? Well, in my opinion, it was market makers, probably market makers that have been accumulating shares for institutional clients. So I would not be surprised to see the stock at least reverse back up in the near term. And it doesn't have to necessarily be a stock that's being accumulated for institutions. Market makers trade on their own account. It could simply be that everybody's been shorting, and now they've just built up a huge position on the long side, and they just put all their capital to work at the end of the day and trying to trigger a little bit of short-term rally. Maybe we go up to the moving averages and come back down. But just going back up to the moving averages would probably be a 10% move. So SCVL is one I think is worth watching. Next up, this is a stock that hasn't been doing well, but I'm still pretty bullish this stock. And this is LiveX Live Media. First, the media stocks have been getting hit pretty hard to the downside. So you have to understand that. So the stock's seeing a lot of pressure just because its peer group has been sold off pretty heavily. But when I look at this chart, I see a stock that was almost $5 back at the beginning of July, a month ago. Now it's $3.25. And it's also down very close. You can see last week we came down and tested 275. This is a very important support area. So if I'm looking at this right here, I mean, you can kind of see this prior high here and even this prior high. I mean, we could move it up to there, could leave it there. But this one looks good to me because this was a high. We broke out on good volume. We tested it, broke out again, tested it, broke out again, tested it, broke out again, and now we tested it again. So 270, 265, 270 seems to be major support on LIVX. We tested that a couple of days ago, but today we actually put in a higher high and we closed on the high end. If you notice, we have not been doing that for the last couple of weeks. So that was a change in character on the chart with an uptick in volume. I think LIVX could be ready for a run. It is a aggressive stock. It's small cap. It's not for everybody. You do need to be an aggressive trader, but I wouldn't be surprised to see a move on LIVX. And then the last one I had here is PetSmart. And this was a company that I really liked back in April. And I liked it right up until its earnings report. Stock looked good. You can see here, earnings came out right in through here. But this was a stock that went and broke out to a new high. They posted better than expected revenues and better than expected earnings, and yet the stock sold off. But if you notice where it sold off to, it came all the way down to this prior low, did not break below it, and now is starting to turn back up again. This could end up becoming somewhat of a cup off of a long-term uptrend to a new high. This could be a cup. I'm not saying it's going to be. I'm just saying it could be a nice move on Monday. And you can see the volume starting to tick back up again. It could be that market makers have their long position. We could see a big rally here on PetMed. I think I may have said it was PetSmart earlier. This is PetMed, P-E-T-S. All right, let's keep moving on. We're going to get into earnings now. So earnings spotlight. What stocks do we want to take a look at? Well, first one I'm going to pull up is KLA 10 Core. Or I always call them KLA 10 Core. It's KLA Corp. KLA Corp, KLAC. Nice breakout right before its earnings today. Earnings were good. $2.73 versus $2.35. So that's good. But the reaction was not so good. The stock was down almost 3% last time I looked in after hours. So we're talking about maybe $5, $5.50, something like that. So we're probably back in the 202, 203 range after hours, which is still not bad. We're in an uptrend. Sideways consolidation will be fine. I would be okay if the stock pulls back even to the upper 180s. In fact, anything back down around that range, and I would be a buyer. I think you got a nice uptrend, got a group that's been very strong. You can see the accumulation distributions at a 52-week high. So I don't really see anything negative here. I mean, semiconductors have started to turn back up again relative to the S&P, and KLA has been a good performer. So I like the action here, but again, it could be a lot of good news already built in. Earnings come out, we have a little bit of a pullback before another push to the upside. That's what I would be looking for. Another company reporting, Ring Central. This is RNG. They beat 24 cents versus 20 cents, also down a little over 1% after hours. And just like KLA, nice day today heading into the earnings. Actually had a breakout, accumulation distribution strong. If you go down here and look, the stock relative to the S&P is strong, relative to its peers is strong. Volume picked up. I mean, there's nothing bad here, but the stock is still priced for, I'm not going to say perfection because we have been going sideways a little bit here over the last few months, but we're at a 52-week high. So obviously good news is built in. They reported good news. You might get a pullback. I think the 20-day moving average would be very interesting if it got down there. Take-Two Interactive reported after the bell, and another very solid report, 268 in earnings versus 158 expected. That's a huge beat. Stock was anticipating this, and in this case, we actually are getting a positive reaction. The stock up 5.5% after hours. So that would be roughly $8. So I'm going to say it's up trading 175, 176, something like that at last look. This is in the internet space, but I also view this as more of a toy kind of a company. I mean, they've got a lot of the video games and so forth that kids like to play. So yes, it's software, but it's also kind of combination software toys. And both those groups, by the way, have been very strong. And they've got this categorized as internet. I don't know. I look at it, I guess you can call it internet, you can call it toys, you can call it software, maybe a little bit of both or all three. But all those groups are strong groups. And so as a result, I expect the stock's going to go higher. Now, after earnings, would I chase it? No, I would not. Many stocks fill their gaps after earnings, so you might see the stock come right back down. You might see it gap up $8 and then reverse 30 or 20, 25, come all the way back maybe to the 20-day moving average. See a lot of volatility after earnings. So I don't generally chase after an earnings report. All right, what else? How about looking for another, how about SEDG? This was a strong reaction after hours. This is Solar Edge, a renewable energy company. Stock was down during the day, got as low as 162, reversed back up, closed at 173. And the last time I looked, the stock was up close to $20. after hours. So 191, 192, something like that. So off of the low of the day at 162, the stock's probably up close to almost 20% from Monday's intraday low to the after hours, where it was trading after hours. So renewable energy, you can see in a nice uptrend. Solar Edge relative to renewable energy, close to its 52-week high. Great stock, great reaction, accumulation distribution strong. Definitely one I would have on my radar. One stock that did not fare so well after hours, and they missed their earnings, and this is one I talked about, I believe, in Trading Places Live over to Earnings Beats this morning, Monday morning. And that is Virgin Galactic, which is ticker symbol SPCE. And what I said with a stock like this is that when you've got a stock that's heavily shorted, and SPCE is one of the most heavily shorted stocks, it's broken out, which is nice. I mean, if you can catch a breakout, you can really have a nice gain in a short period of time. But you've got to be careful going into earnings, I think even more so in a stock like this, because there's a reason why it is one of the most heavily shorted stocks. There are a lot of folks that are not believing what this company is selling. And I don't mean literally, I just mean, maybe what they're saying is not necessarily believed. And maybe the valuation, a lot of folks believe the valuation is too high for this company. But when there's a lot of shorts on a stock, many times the shorts get it right. I don't want to say that just because there's a lot of short interest that a stock is bullish. That would not be the case at all. So we want to be careful going into earnings reports. If I have a profit and I know I've got a stock that's going to be reporting that is heavily shorted, I will take at a minimum probably half of my position off the table, and many times all of it. I just don't want to take a chance. Anyhow, they reported after the bell. They did miss on their earnings. They came in with a 30-cent loss. The market was expecting 28-cent loss, and the stock is down, or was down last I looked, almost 8% after hours. So we're talking about, close to a couple bucks. Could be back down at that 20-day moving average, or maybe even below. And it's possible we go down and hit this breakout level down at 19.5 or so, 1975. So there's some things to be worried about here. All right, let's keep moving on. Let's wrap up the show with the 3 you must see. I'm going to start off with a stock that really has just gotten beaten up badly for a while. And this is Triumph Group. First of all, look at the AD line throughout all the way since the pandemic began. It turned down with the action in the pandemic. And even when it's tried to rally, it, for the most part, just keeps going lower and lower. But the last few days, look at these tails. Volume picked up on Monday, and we saw a pretty big reversal. We actually broke to a new high, which was encouraging after several days of putting in lower highs. So I think TGI might be in store for a reversal here in the near term. Now, it is not a favorite stock of mine. Look at this chart. I think it's ugly. Relative strength, everything about this chart I don't like. I am talking about a short-term bounce. If I got in and it went up 10%, I'd probably be out. Maybe it goes higher. Maybe it doesn't go up at all, but I think this is an opportunity perhaps in the near term. Next up is CARA. This is Cara Therapeutics. Nice reversing candle off the downtrend. It is in the biotech area. I said I like biotechs. I like this reversal. I think it's got a shot to move back up into the 18, maybe even break out above 18 on a closing basis. Last stock is big. I wrote about this in the Don't Ignore This Chart blog, a couple weeks ago, right in here when it was close to the 50. It reversed up, went to resistance, failed, came back down. This stock two times in the last 2 months has raised guidance. So I like this reversal off this recent downtrend. I think this could be the time we go up and break out through $45. So I like big lots. Anyway, that's it. I hope everybody has a great day tomorrow on Tuesday. And I'll be back on Wednesday over at Earnings Beats for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.